Imagine waking up one day, opening your investment account, and seeing a steady stream of money being deposited every month. Not a paycheck, not a bonus, not money from working another hour, but cash flow generated by the capital you've spent years building. That's exactly why more and more American investors are paying attention to income-generating ETFs, especially funds that use covered call strategies. And if you're in your 50s, 60s, or have started seriously thinking about retirement, I understand why numbers like a 10%, 15%, or even 20% plus yield can be incredibly appealing. Because as we move into the later stages of our careers, the question is no longer simply, how much money can I make? The real question becomes, how can I turn the money I've accumulated into a sustainable source of income? But this is also where we need to slow down for a moment. Because when it comes to investing, there's one truth I've seen play out over and over again. An attractive number does not necessarily mean it's a good investment. You might see an ETF paying a very high distribution and think you found an income-generating machine. But if, while receiving that income, the value of your underlying investment declines significantly, the story looks very different. Imagine you have $100,000. An investment generating $15,000 in income over 1 year sounds fantastic. But if your portfolio loses $12,000 in value by the end of that year, your actual financial experience is very different from what that 15% yield might suggest. That's why today I want us to look at covered call ETFs from a different perspective. Instead of asking only, how much money does this ETF pay me every month? We should also ask, after accounting for all distributions, price movements, and what happens to my principal, how much value do I actually have left? That's where the concept of total return comes in. In the video we're analyzing, these ETFs are compared with familiar benchmarks such as the S&P 500 and NASDAQ 100. And something interesting becomes apparent almost immediately. Some of the ETFs with the highest yields aren't necessarily the ones producing the best total returns. On the other hand, some strategies that may not look quite as flashy at first can potentially provide a better balance between income and capital appreciation. OVL is one noteworthy example among the strategies related to the S&P 500. The video shows OVL standing out for total return during the period analyzed, while GPIX, SPYI, and TSPY are also among the covered call strategies worth paying attention to. And when we move over to the NASDAQ 100, the story becomes even more interesting. TDAC emerges as one of the leaders in the data presented, while zero-DTE strategies also demonstrate notable strength. But I want you to remember one thing before we go any further. There is no single ETF that is the best for everyone. A 35-year-old investor who is still building wealth has very different needs from a 65-year-old investor who is living off a portfolio. Someone who prioritizes capital growth will look at ETFs differently from someone who needs monthly cash flow. And someone who can tolerate significant volatility will make different choices from someone who loses sleep whenever the market drops 10%. So our goal isn't to find some magical ticker. Our goal is to understand how the machine behind each ETF actually works. How do covered calls generate income? Why can an ETF with a high yield fail to produce a high total return? Why can a strategy that sells covered calls on only part of the portfolio, such as XYLG, potentially have more upside than selling covered calls across the entire portfolio? And why can leverage turn an already powerful strategy into a double-edged sword? Those are the questions worth spending time thinking about, because ultimately, investing for income isn't just about how much money you receive today. It's about how much capital you still have working for you to generate income tomorrow, next year, and 20 years from now. And if you're preparing for a future where your money needs to work for you, that distinction could matter far more than a few percentage points of yield advertised on a screen. So in the next section, we're going to break down each strategy from the S&P 500 and NASDAQ 100 to zero-DTE strategies and leveraged ETFs. And most importantly, we'll look at them through a lens that many investors overlook. It's not about which ETF pays you the most. It's about which ETF can create the most sustainable value relative to the level of risk you're taking. Now let's take a deeper look at what really sets these covered call ETFs apart. Because when you look at the rankings, it's very easy to fall into a familiar psychological trap. You see an ETF paying 15%, 20%, or even more, and you immediately assume it must be better than an ETF generating 8% or 10%. But the financial markets don't work that simply. A covered call ETF is essentially making a trade-off. It gives up some of its future upside potential in exchange for option premium today. Imagine you own a house worth $500,000 and someone is willing to pay you money for the right to purchase that house at an agreed upon price in the future. You receive the money today, but if the value of the house suddenly skyrockets, you may not get to enjoy all of that appreciation. That's essentially the idea behind a covered call. The fund owns the underlying assets, then sells call options and collects option premiums. Those premiums can become an important part of the cash distributions paid to investors. But in exchange, when the market rises sharply, the fund may have to give up some of that upside. And that's exactly why I always want you to look at total return rather than focusing only on yield. Let's say there are two ETFs. ETF generates a 15% annual distribution, but the value of its assets falls by 8%. ETF generates only a 9% distribution, but the value of its assets rises by 6%. If you only look at the yield, ETF looks much more attractive. But if you're building wealth for the next 10, 15, or 20 years, the story is completely different. Because ultimately, the money you'll be able to use in the future doesn't come only from the cash deposited into your account each month. It also depends on how much capital remains in your portfolio. This is one of the reasons experienced investors don't simply ask, "How much does this ETF pay?" They ask, "How much income am I receiving and how much growth am I giving up to get it?" That's a much more sophisticated question. And when we apply that way of thinking to the S&P 500 group, OVL becomes particularly interesting in the data presented in the video. OVL isn't simply a traditional covered call ETF. It uses a put-based strategy, and during the period analyzed, its total returns stood out compared with many other choices. GPIX, SPYI, and TSPY also appeared among the notable strategies when compared with VOO. That teaches us an important lesson. There are many different ways to generate income from the same market. You don't necessarily have to sell covered calls in exactly the same way every other fund does. And when the strategy changes, the results in different market environments can change as well. Let's take XYLG as an example. XYLD is well known for using covered calls across a large portion of its portfolio, but that also means it gives up a significant amount of upside when the market rises sharply. XYLG takes a different approach by selling covered calls on only a portion of the portfolio. It may sound like a small change, but from an investment perspective, it can make a very significant difference. You still receive option income while retaining more potential participation in the market's upside. And this is a principle I think every income investor should remember. Don't just ask, "How much income am I getting?" Ask, "How much upside am I keeping?" Because the stock market doesn't move sideways all the time. There are periods when the market rises slowly, periods of intense volatility, and periods when the market rallies so quickly that almost nobody has time to prepare. In a sideways or moderately rising market, selling options can be a very attractive strategy. You collect premiums while the underlying assets don't move too far beyond the strike price. But in a strong bull market, the cost of selling calls can become much more obvious. You've sold away part of your ability to benefit from major upside moves. And that's also why I don't want you to look at JEPI simply because it's popular. JEPI has a huge following among income investors. But in the data presented in the video, JEPI was not the winner when it came to total return. That doesn't mean JEPI is a bad ETF. It simply shows us something important. An investment product can be a great fit for one person and not necessarily the best choice for someone else. If you need relatively consistent cash flow and aren't trying to maximize growth, you may evaluate an ETF very differently from a 40-year-old investor trying to double their wealth over the next 10 years. That's why, what is the best ETF is actually an incomplete question. The better question is, what is the best ETF for which goal, over what time period, and at what level of risk? Now let's move over to the NASDAQ 100. This is where the story gets particularly interesting. The NASDAQ 100 has significant exposure to technology and growth companies. That means volatility can often be higher than what you would experience with a traditional broad market portfolio, and volatility has a direct impact on option pricing. When the market expects higher volatility, option premiums tend to increase. This helps explain why option income strategies tied to more volatile assets can sometimes generate very attractive distributions. In the data presented in the video, TDAC stands out among the NASDAQ 100 strategies, while QDTE also shows notable results. And this is one of the things I find so interesting about covered call ETFs. You're not simply buying an ETF, you're choosing how you want to trade off income versus growth. On one side, you have the potential to retain nearly all of the NASDAQ 100's upside. On the other side, you sell away some of that upside in exchange for option premium. And between those two extremes, there are countless different strategies. Some funds sell calls across the entire portfolio. Some sell calls on only a portion of the portfolio. Some use short-term options. Some use zero DTE strategies. And some funds even use leverage. But leverage is where I want you to be especially careful. Leverage can sound very attractive when the market is moving in your favor. If an asset rises sharply, leverage can magnify the gains. But the market doesn't move in a straight line forever. When the market falls, leverage can magnify the losses as well. U.S. regulators have also warned that leverage strategies can significantly increase both potential gains and potential losses. So when the video shows leveraged versions of strategies such as TDAC or SPYI generating very strong total returns during the period analyzed, we shouldn't simply look at the performance numbers and say, this is the best ETF. We need to ask another question. Can I actually withstand the periods when this strategy performs very poorly? That is the question a long-term investor needs to ask. Because investing isn't just about knowing how much you could make. Investing is also about knowing how much you could lose and still stay in the game. And once you understand that, you'll start looking at ETFs such as TDAC, GPIX, SPYI, OVL, XYLG, and leveraged ETFs through a completely different lens. It's no longer a competition to see which fund has the highest yield. Instead, it becomes a search for the right balance between income, growth, volatility, and capital preservation. And that's exactly where we'll continue in the final section. When covered call ETFs expand beyond the S&P 500 and NASDAQ 100 into gold, Bitcoin, and leveraged strategies, we'll have to confront an even more difficult question. If your goal is to build passive income for many years, is a high yield today really worth sacrificing the growth of tomorrow? Perhaps after looking at all of these strategies, you've realized that the story behind covered call ETFs isn't simply about finding the fund that pays the most, because if all you had to do was find the ETF with the highest yield, investing would be much easier. We could simply open a data table, sort the ETFs from highest to lowest, and pick the one at the top. But in the real world, things are never that simple. A portfolio is a lot like a garden. You can't just look at how much fruit you're harvesting today. You also have to look at whether the tree is healthy, whether the roots are still strong, and most importantly, whether that tree will still be able to produce fruit next year. That's also how I want you to think about income ETFs. The cash flow you receive today is important, but the ability to preserve and grow your capital is what ultimately determines your financial future. And that's why total return matters so much. In the analysis presented in the video, OVL stood out among the S&P 500 related strategies, while GPIX, SPYI, and T-SPY also delivered notable results. For the NASDAQ 100, TDAC and QDTE were among the standout names during the period examined. But remember, these results reflect only a specific period of time. This is something I want to emphasize, especially if you're investing for retirement. An ETF that ranks at the top today does not mean it will still be at the top 10 years from now. The fund strategy can change. Market conditions can change. Interest rates can change. Market volatility can change. And those changes can make a strategy that once performed extremely well much less attractive. So don't turn today's rankings into a promise about the future. Think of them as a snapshot. They tell you what happened, but they cannot guarantee what happens next. This becomes especially important when we're talking about ETFs that use leverage. During a strong bull market, leverage can make the returns look incredibly attractive. But rising markets aren't the only thing an investor will experience throughout their lifetime. There will be days when the market falls. There will be difficult months, and sometimes there will be years when you start questioning whether your strategy is still the right one. That's when an investor's ability to stay the course is truly tested. A strategy can look fantastic on a spreadsheet, but if the volatility causes you to panic and sell at the bottom, then in reality, it may not be the right strategy for you. That's why I've always believed that a good strategy isn't simply the one that makes the most money. It has to be a strategy you can actually stick with. And this is also why we need to look beyond the S&P 500 and NASDAQ 100. The video also discusses covered call strategies involving gold and Bitcoin. Within the gold category, Curve's KGLD stands out during the period analyzed. Within the Bitcoin category, Global X's BCCC and Neos's BTCI are included in the comparison, while a leveraged Bitcoin covered call strategy also showed very strong total return during the period examined. But Bitcoin is a completely different story. Bitcoin is significantly more volatile than traditional assets like the S&P 500. So when you combine Bitcoin with option income and leverage, you're no longer simply looking for a source of passive income. You're accepting a higher level of risk in exchange for the potential to generate higher total returns. And that is a trade-off. There is no free lunch in the financial markets. If a product gives you the potential to earn more, always ask yourself, what am I giving up in exchange for that? Maybe it's upside. Maybe it's stability. Maybe it's a larger drawdown. Or maybe it's simply the fact that your cash flow could change significantly depending on market conditions. This is especially important for people who are living off their investment portfolios. If you still have 30 years to invest, you may have plenty of time to recover from a difficult period. But if you're already retired and withdrawing money from your portfolio every month, a major downturn at the wrong time can create much more pressure. So when choosing a covered call ETF, I wouldn't start by asking, which ETF pays the most? I would start with 4 simple questions. How does this ETF generate income? How much upside does it give up? How has its total return performed across different market environments? And most importantly, can I actually tolerate the risk? If you can answer those 4 questions, you're already much further ahead than someone who simply looks at a yield number on a screen. Because the ultimate goal of income investing isn't to make your account balance look impressive every month. The goal is to build a financial machine that can work alongside you for many years. A machine that generates cash flow, that has the potential to preserve your capital. And, when market conditions allow, can continue growing that capital over time. That balance is difficult to achieve, but that balance is what creates a mature investment portfolio. And if I could leave you with just one message after this entire analysis, it would be this. Don't let a yield number determine your financial future. Look behind the number. Understand the strategy. Look at total return. Look at volatility. Understand what you're giving up in exchange for that income. And remember that a good portfolio doesn't necessarily have to be the portfolio that makes the most money in a single year. Sometimes the best portfolio is the one that lets you sleep well at night while still leaving you with enough capital to keep investing tomorrow. Because financial freedom isn't just about how much money your portfolio pays you. It's also about not living in fear that one major market downturn could take away what you spent your entire life building. Covered call ETFs can be a very interesting tool for investors seeking income. But just like any other financial tool, their value depends on how you use them. Use them to build a portfolio that fits your goals. Don't use them simply because a high yield number gets you excited. And above all, remember this. Money isn't just about how much you make. It's about how much you keep, how much you grow, and most importantly, how long it can help you live the life you want. That is the true meaning of passive income. And that's also why we invest in the first place. Thank you for staying with me all the way to the end of the video. If you found this analysis helpful, please hit the like button, subscribe to the channel, and share this video with someone who is also looking for ways to build long-term income from their investment portfolio. And remember, don't just chase the highest income. Look for the best balance between income, growth, and risk. I'll see you in the next video.